Hey, how about that? How about that? Cowboys win? Oh, they're gonna win. Who do they play? No, I know, but who do they play? What team is it? You don't know? It's game day, baby. I don't know. Monday Night Football and the Giants? All right, little rivalry there. How we doing up there and around the rest of the world? Hope all is good. Sorry for the delay there. Looks a little funny today, but that's all right. What? Looks great, right? Welcome to the show. Where you guys go? There, you're over there somewhere. Happy Monday. How you doing? Oh, we have to put each one of those back up. That's right. I don't know if you guys noticed, but we have a storm heading our way here. I'm going to pop over. You got that good? Let's go to the charts page here real quick. Here is the storm, and the little arrow is exactly where we're at. So, may not need to explain this to you guys, but we're here just at the tip of that arrow. And so we've been getting ready for hurricanes today. It's likely going to be a rough week, right? So we know that. We can handle it. This is all stuff we've done before, but there's the level of preparedness, that we're going to have to follow. So we may not be here tomorrow. It depends on where the thing turns, but I just want to throw that out there. So if we're not here, you know that we're safe. Maybe we'll do some kind of TikTok or something out of whatever the kids are doing these days. But it's about to get as bad as the stock market is out there here for us in Florida. So with that in mind, I want to give you some good stuff here today. Just know that maybe there's no show if we run out of power or something happens. We've got all our contingency plans in place here. If your clients were already ahead of that, thanks to Doug. We got Doug here. He prepares for everything. But we may have to cancel the Wine and Wealth on Thursday. Oh, there's going to be a pre-recorded one. Oh, Wine and Wealth, because thanks to Eric. Okay, cool. Oh, a good one, actually, the estate planning. He's talking with an estate planning attorney, so lots of cool things there for clients to get the lowdown on all of that. In our notes from Jazz this weekend, actually did a full breakdown of this bear market. I just had nothing else to do, so I went through every single bear market, the declines, the rallies, trying to show different ideas and thoughts there. It's a good one. If you're a research member or a client of ours, you may want to check it out. And I'll share some stuff with you here a little bit later for those of you that are just fans and like watching. We appreciate that. Look, here's where we came from. You remember, right? The Fed was saying, we're shooting for a softish landing, which just means kind of a light, soft recession there. Then they changed it. Jerome Powell changed it to, we're going to feel some pain. All right? You all right over there? He's good. Okay. It's like you're looking for a beat. So we're going to feel some pain. Then last week, Jerome Powell says no one actually knows how bad it's going to be. So I don't know if he's throwing his hands in the air there. And then over the yesterday, we had the Atlanta Fed president say, we're going to change that to, we're going to feel some deep, deep pain. Those were his three exact words there. So that doesn't put a lot of confidence in investors. And that really should make you think, why would the market bounce today? What would be the reason after all that bad news? Not to mention, the other stuff going on around the world, inflation still being high, supply chain issues being still an issue. So yeah, right? It really puts you in that mindset of, there's just no reason that I should put new dollars into the market right now. Now, best case scenario, if you're out there hunting, got your shopping list ready, I'll share with you some cool places you can look for ideas. But best case scenario, since there's nothing good on the horizon, the best thing that could happen next is the market to flush out, which is not going to feel good, right? It's going to make you think, oh my God, this is the time, this is the end of the world. But that flush out will actually mark a bottom. That's exactly what we're setting up for here. We've seen it. You've seen it. Come on. So we know that's probably the first, hey, there's a good sign, maybe some reason we could buy stuff, where stocks are literally valued lesser than what the recession could potentially be. So you see that in the bond market. I'll review that here with you in just a second. Anyways, taking a look over here today, I'm going to start with the Dow. Not messing around today with you. We got a new low on the Dow, actually. It fell to bear market territory on Friday. This just confirms it here today. It is the most extended of all the major indices. So if you're an index player and you say, I get that, man, we're going to be extended here, I'd like to buy that. You may look in the Dow first. I'm not telling you what to do, but that's the most extended at the moment. The S&P is just off bear market. No, we're bear market territory here today. And again, it seems like we're trying to flush out the lows, right? It just looks like that's exactly what's going to happen there. We're down 5 of the last 6 weeks. Now that don't feel good. I get that, right? There's a discount that we all like, and then there's the holy cow, come on, quit whipping me here, right? So here's where we stand. We got 1 week left in September. September's known for being the worst week of the month. We know that. I've shared all that data with you there. This September, month to date, kind of ranks as one of the worst there if you haven't seen one before. We're down over 7% here just for September. It's kind of rare to see a bounce back in the last week of September. It's only positive 42% of the time. You got to go back to 2020 to find the next closest time where we fell 7%. We bounced about 4% before the end of the month there. Now, let me dive a little bit deeper in here. Sector-wise, if you say, well, all right, well, which sector has the best possibility of bouncing? In other words, the best stats, right? So we'll start with the industrial sector. That's actually your best one. The next week's performance for the industrials averages a gain of 1.3% in the last week of September, especially after being down more than 5%. Then you got tech stocks. That's a tough place to look right now. It's no way to sugarcoat that. Average bounce is about 0.75%. And coming in third place is consumer discretionary. That'll be XLY if you want to follow it that way. About 0.25% gain. Every other sector averages a loss in the last week of September, especially when we're down this much. So you don't have a lot of good things to count on. I don't know how, there's no way to sugarcoat it. It's just, hey, this is pain. The Band-Aid's being ripped off right now. How you handle it is how you will determine your outcome in 5 years, 10 years, something like that. So if you're panicking, it's part of the game. You're going to have to relax a little bit there and see what we can get through here. The NASDAQ, worst 2-week stretch since COVID. So you just lived through it, man. If you were not nervous during COVID, you're not nervous now. If you were panicking during COVID, you're panicking now, right? That's the last time we've seen something like this. We've lost over 5% just this last week there. Now, remember this. If I could put a little something nice onto it here. Let me try to help with something here. Think about what people are looking at around the world. Do they have it good in their country where their market's doing well, pulling back a little bit, but it's not that big of a deal? Or is the U.S. performing better? I was actually reading something by Goldman Sachs. We get all their research here, and they are looking at the U.S. being a safe haven. That doesn't mean that we're not potentially going to have a recession, everything's going to be bad. But if you look at the return since 2009, the U.S. is beating France, the UK, well, the UK easily, Germany, Asia, go wherever you want to go. The US is beating it in terms of annualized returns, right? So they look at this as saying, when the rest of the world pulls back, they're going to look for the best returns. And they went on to explain how that happens. So there was a time, Brazil, right? Brazil was doing really well. The market here was pulling back because of COVID and stuff. Money went to Brazil and Brazil took off. Right? There was a time when China was doing really well. The U.S. not so good. Looking around the world, not so good. Europe and things like that. And money went to China. So their argument is that could be a little bit of a saving grace. Historically, when the world slows, everybody looks to move that money to the best performing area. I had to have something. I was trying to find something that would be like, okay, well, it's not so bad out there because otherwise I got nothing. So that's how far I had to look. Anyways, going back over here to the charts, remember also, by the way, inflation may be peaking here in the U.S. So we don't know for sure, but it looks like it's peaking in the U.S. Can't say that for India, the U.K., what else I put, China and others, really. You can't say that over there, at least as of yet. So that's maybe a reason for people overseas to bring in a little bit of money, and we welcome it, we welcome it. All right, let's take a look over here at bonds. Whoa, horrible day. If you have a 60-40 stock portfolio or you have stocks and bonds, there's nothing you can do. You are hitting or getting hit on all of it there. Everything is falling. If you have a like a balanced fund where you got stocks and bonds in there and you're trying to let them fight it out, right? They're both dropping. I've shared that data with you here today. Anything bond oriented, just in horrible shape. The yield curve further inverting there. Now, the 2-year, I'm showing the 30-year here at the moment. I'll go down to the 10 just to show you the difference there. But the 2-year is now paying comfortably over 4%. Remember when that almost went negative, right? So we're now comfortably over 4%. Now, remember, I'll teach you something. So when we look at the 2-year, or if you're ever looking online or wherever you look for your stuff, the 2-year is known as a prediction for where the Fed funds rates are going to be. So in other words, 4 to like 4.25% right now, maybe 4.5. So that's what people use that for. In other words, the 2-year Treasury builds in expectations of where the Fed funds rate's going to be. So it's giving you that little glimpse. They've overpriced at the moment. However, the Fed says they're going to keep raising there. So when people predict where the Fed funds rate's going to be, we're referencing the 2-year. That's just always think of it that way. 2-year Fed funds rate, that's where it's at. Now on the charts here, we've got the 10-year, and the 10-year is what people use for long-term forward inflation. I don't want to say long-term inflation, but long-term forward inflation expectations. We're currently trading at just over 3.7%, almost 3.9%, I believe. Did we break 4 today? I don't think we did. So the bond market, in this case, is looking at that and saying that's where inflation's likely going to end up, right? And this is a year out. You're looking out that almost a year out at this point. And so with that, bond yields go up, bond prices, as you can see, go down. The bond market is literally taking down the stock market at this moment because they're pricing in not under 2% inflation, and they're pricing in 4 to 4.25 Fed funds rate there. So we're all responding to that going, okay, that's a concern. Why is that a concern? Because now we have borrowing costs rising, but we don't have cheaper prices yet. We hopefully will, but we don't have cheaper prices yet. So we haven't seen this sharp decline in housing prices just yet. Everything goes back to that, right? You get a new house, you buy a new carpet, you get a new appliance, you get some new toys to hang on the wall, you get some new TVs, whatever it is. You're a little loose with your spending there, but you may not borrow to go buy the house. You may not use lines of credit to buy TVs or whatever you put your stuff on there. Consumer loan applications tend to go down. They're already falling on a daily basis when you look at the hyper tracking there. So we're already seeing that. We're slowing the economy down, but yet the bond market's making harder and harder and harder for people to decide to use credit, to use loans, to use their home equity line of credit, their Best Buy card, I don't know, whatever it is that you have there. So what that means for you guys in the stock market is that corporate earnings will likely have to be brought lower, right? Because if you're not willing to borrow, to buy, to use your Visa or whatever to go buy, that means you're not buying stuff. It's the simple economics, right? So it means that the expectations of what a company like Home Depot should make, we need to lower that. So that could also be a saving grace as well. I say that because if we lower our expectations so far and companies report just a little bit better, that actually is a good thing. That could boost the market there. So right now you see expectations turning negative. They're already negative in terms of the earnings expectations there, but we'll make that a video or something in the future there. Okay, so I wanted to give you something here today to use. Since we may not be here going forward, but we'll be just fine. If you were going to look for stuff, this is shopping season, right? You're literally saying, I want to build a portfolio. I don't want to buy now, but I want to get something and build it so that I'm ready to deploy that watch list, deploy that cash, and get invested in something. So where should you look? I can't tell you exactly what stocks to buy. I get in a lot of trouble for that from the good old SEC, and we like to stay on their good side there, as we have. But I can point you in the right direction and give you a lot of homework without you having to, or do a lot of your homework for you without you doing it. Let's take a look. Let's say you wanted to chase dividends. I've shared a little bit of this before, but let's go further. Here's the dividend yield by sector. This doesn't mean that you might be a dividend investor. It could mean that you say, I'm willing to buy a discount, but I'd like a little dividend as well, just in case. You know what I mean? It's not going to offset much more than one day's worth of markets move, but you know, for my money and for my investment, I want a little dividend yield. Well, you've either got to be in real estate or energy, the only two sectors currently yielding over 3%. I don't think utilities quite hit it today. I don't think so. But anyway, so that's where you'd be looking for that. Now, these are going to be a little bit slower moving areas of the market, so you got to realize that if you were willing to go over to tech for whatever reason, you would enjoy a smaller dividend yield, but faster, more rapid growth there. So the first thing you want to do is go, okay, well, what am I getting for my money if there's no performance? If the stock market just goes sideways, I got to get something. Think of us here at Jazz Wealth. We can't just invest someone's money and get nothing. There has to be something there, right? We can, the markets can be down, all this stuff, but we have to earn something. And you should think that way too. You need to earn something on your dollars, right? So share this with your kids or something. There's no sense in buying something that you're not going to at least find, like gold. I don't get it, right? You're literally directionally playing gold if you buy it. There's nothing else you can do with it. There's no return for just letting money sit there. We fortunately managed like $250 million. It can't just sit there, right? The internet would go crazy with people saying, oh, they're not doing anything. So we can't have that. Anyways, here you go. So this is your current standing point here. Now, here's how you take it a step further. This is your lesson of the day, right? You look at that and go, I'm getting 3.4% is the average yield in real estate. But does that mean every stock is doing well and yielding that much? Or are there some that are yielding a whole lot and most yielding nothing, right? What I want you to be able to do is not have to go digging through a bunch of stocks. So we did this one little step further. We said, show us the percentage of stocks in a given sector that have greater than a 5% yield. See what happened? All of a sudden, real estate, we can now tell by looking just at two charts. We can go, oh, that's a high yield, but there must be just a handful of stocks skewing the average because only 12.5% of stocks in the real estate sector are yielding more than 5%. And in order to get to almost that over 3% we just showed, you have to have 5%ers, right? You have to have 1%ers to skew the average, basic math, right? Look at energy. Energy has the most amount of stocks with over a 5% yield. And by the way, I would add that are holding up better than most of the market. So you might look in there and see if you like natural gas, if you like crude oil, if that's your thing, right? You might consider something like that. So now you know that if you flip through a list of energy stocks, you're very likely going to hit on a whole bunch of them that have yet to pull back as much, but also are yielding higher amounts as well. So if those energy stocks stabilize and don't do anything or give you this sort of choppy, chaotic movement, you're getting a higher yield from the individual stocks, from the sector, and you haven't fallen as much. What happens when the market stabilizes and the market starts to go up again? People go, oh, I don't know, what do I want to buy? I want to buy the stuff that held up the best. That's where big money goes. They can't justify to their clients, well, the market fell, and this sector over here fell the most out of every single sector, and it's likely not going to perform well, but because it's cheap, all of our dollars go there. You can't do it. They have to justify, we have the strength. We're going to buy the stocks that have held up and weathered the storm and all that stuff. There's commercials about that, right? That's how fund managers need to think if they want to keep their job. So anyways, just wanted to point that out to you to give you a place to start to kind of look there. Took a little bit longer on that. Do apologize. We'll wrap it up here with some stocks in the news, maybe a couple other things too. So Apple, they are moving some of their production of the new iPhone 11 or whatever it is to India, and I think that's not new news, right? That was rumored for a while. They hinted at it. It's happening, right? So that's that one there. What else do we got? Let me go over here so I can. The stocks in the news one so I can actually see. We'll do this guy, type it in there the right way. There we go. Citigroup makes new lows here today. It's not wanting to open offices in New York City. They want to expand, but they said, we're going to look in New Jersey and Connecticut instead. And I don't know, I could probably guess why, but they're going to spend some money in other states. Ford. So Barron's, this came out of Barron's over the weekend. They said Ford's actually a good buy here. I can't say whether it is or not. But Ford gave a warning last week about the money they're going to have to spend, the earnings hit they're going to take in order to do that. And Barron says, that's a good thing because they actually stand a chance to dominate some of this EV market nonsense. You got GlaxoSmithKline. Now I guess they just call themselves GSK. That's different. Didn't know that. The CFO retired. The guy that's taken over there is from, the guy that's taken over is from the Burberry, the fancy clothes there, the overpriced stuff there. So I don't know. I don't see how, I don't know what his background is, but the headline part of it is like, what? What's going on there? Whole Logic, they're going to actually be buying back about 7% of their entire market cap there. It's $1 billion if you want to do some quick math there. So that is very helpful. Stocks that are doing buybacks get bounces. That has happened for the last year and a half or so. Where do you put the money? Do you give it to the shareholders? Do you buy back your shares? The argument is buy back your shares. You're essentially giving it to the shareholders in the form of higher returns. And so that is the game being played. Okay, a couple other things. Changes in the S&P, by the way. Remember PG&E back in the day with all that chaos in California? They're getting added to the S&P. So that stock is almost at new highs. A lot of utility stocks, very strong, actually. EQT, this takes you over to, EQT is natural gas, but I can't type the symbol here today. There you go. They're getting added to the S&P 500 as well, and they are taking the place of Duke Realty. So changes coming up there on October 3rd for all three. EQT is leaving the S&P 400, going to the S&P 500. Now, tomorrow, you have 1, 2, 3, 4, 5 Fed members speaking. There's no real news coming out tomorrow, but you have 5 of them boogers going to be talking tomorrow all around the world, actually. One of them's in Singapore, one's in London. I mean, they're spread out over the world. And do you think that they're going to change their tone tomorrow? Just play it through, right? So is tomorrow the day to invest in the stock market? Well, I don't know. Is the Fed going to just all of a sudden say we're no longer going to feel deep, deep pain? They ruffled through the papers and they found out, oh, we misspoke, right? Oh, we got some new data here. No, right? So if you're here like us and you're like, well, there's going to be a hurricane, and are we going to miss the bottom in the market? Probably not. It would be one of the riskier buys that you would have to do. Anyways, I'll take your questions if you have any there, and then we're going to get out of the way here for you. AV nonsense. Is that what I said? Is that a Freudian slip there? Yeah, we're always just one comment away from being canceled. You know, I don't know if that's still a thing, if the kids still do that, but yeah, I don't think the electric vehicle stuff is nonsense. I think the way we go about it is nonsense, right? People buy stuff that they think is cool. And Elon Musk made electric cars cool. Okay, you don't have to force us to buy them. People will buy stuff they think is cool. Anyways. And Richard says, hey, man, the economy's in great shape, man. The Fed members are just, just joking around. You know, that'd be a pretty horrible joke. Yeah. Holy cow. I appreciate all the kind words about the hurricane and everything, but, just careful what you believe on the news. Everybody in Florida, we're kind of like, this is more of a pain than anything. We have it all prepped. We do all this stuff. Maybe not, getting hit like we're supposed to get hit, but, they really sell it on TV pretty aggressively there. So careful there. Funny story, actually. 3 years ago, was it over in Pebble Beach? We got hit pretty hard, and trees thrown everywhere, roads blocked, power's out and everything. And Anderson Cooper was on the corner on our street. Yeah. It made it look like all hell was breaking loose. And we were walking the dog on the golf course. I know it was chaotic, but just careful. That's when your grandma starts calling. You okay? We're okay. We're all right. Having a hurricane party? No, but my daughter was hoping to have a party on Saturday, so I don't know how that's gonna go. I don't know. What happened to the package? Oh, the Dogo. Doug won. I believe Doug won hands down on that one. Oh, and Cody posted the results there? Yeah. What do we got here? Craig says, how do you go from a watch list to active buying stage? Yeah, that's part of the fun, right? So you're probably saying, because I was mentioning, you build a watch list. Well, when do you know you're going to start buying there? Do you have any rules on how you would build a portfolio and why? Would be my starting question there. And Dustin Dodge is gonna spend his bonus on discounted stocks. Gets his bonus in a week. Cash that check, man, before they change their mind. Yeah. It's me says, should we still be buying the world? The world? Like building a fund out of everything? I don't know if there's a need for that because you would eventually you'd start picking out some of the areas that kind of got it rough right now. UK. Yep. Yeah. Why is it Ian after Fiona? I don't get the name. There's a list somewhere in there. I don't know. Either way, we're going to deal with it. We'll be here. We'll let you know we're safe and all that stuff. But if it's not that bad and it goes magically like this way or something, we'll be back tomorrow. But if not, yes, we're just kind of going to pack everything up. And I appreciate you guys watching. We will be back. I don't know when. We'll just be back and we'll be back though. You know what I mean? Enjoy.